What is up, guys? I'm Nick Zolotas.
What is up, guys? I'm Peter Lutz, and this is the Long Game Podcast. We're going to be talking all about real estate, every aspect of real estate. And 3, 2, 1.
Today we have with us Jay Goldberg. Jay is incredibly well known around the North Shore. When putting this together, obviously is the first one that I thought about, especially we've done a few deals together in the past, and I've been wanting to sit down with him for a while, so what better way to have him here talking with everybody and getting to know him. So Jay, super excited to have you here.
Thank you, guys. Excited to be here.
Thanks for coming, Jay.
So yeah, obviously, if you want to just give a little intro about yourself.
Sure. Jay Goldberg. I'm the owner of Spire Investments in Beverly. We own residential and commercial property and kind of look at things from an opportunistic investment standpoint. Don't pigeonhole ourselves in any one investment class, always looking for opportunities like a lot of people. So just trying to be selective in which approach you take, and it varies. And a lot of times you diversify to get to where you want to go and goals and things like that. So we can talk about all that stuff.
Yeah, awesome. So, I mean, obviously, I'm sure everybody's interested. We're all into real estate, but obviously, how'd you get into it? What kind of kept you into it?
Sure. Well, you could say it's in the family blood. Technically, I'm a 5th or 6th generation real estate. I had a great grandfather who built high rises in New York City during before the Great Depression and after the Great Depression, and sold them around that time. And then as far as family goes, I have my grandparents, or my grandmother was the number one broker in the North Shore in the late 70s, early 80s. She was named the most influential woman in business on the North Shore. And she was the only woman out of the top 10 on the list. All the rest were guys, and she was the only lady. So she probably sold, if you bought a house in the 80s, or you probably bought it from my grandmother, Barbara Goldberg. And then she had 4 sons, one of them being my dad. They started a company called Goldberg Properties, which is here in Beverly. And they only had a handful of properties from what my grandparents had, and really took off and did their own. And so my dad and his 3 brothers were buying residential and commercial properties on the North Shore. And then my dad kind of went off on his own while investing with the company, doing his own multifamily properties, really mostly exclusively residential. I can give you my history when I came on, but then a few years ago, I started Spire Investments, where I'm doing my own deals and still involved with other things as well. So it's kind of been in the blood. I went to school for real estate and went to UConn, and they had a real estate program and major there. And so I really enjoyed that. And then after that, took my career, did corporate consulting on a transactional basis for Ernst & Young, got to travel around the country for a few years. And that was more corporate real estate involvement, which I didn't have a clue, because I was always small town field kind of real estate, going around with my dad to multifamilies and learning that. But when you get in the corporate environment and transactional and consulting with big companies, it's a different animal. So that was interesting. And then I took that. I wanted to go off, and I always knew eventually I wanted to come back to the North Shore and then buy real estate and build wealth. And in the meantime, though, I said, let's work for others, learn from others, do it under their microscope, see what you can, and take little tidbits that you can bring back to yourself. So I did the corporate consulting, started out with the book knowledge first, obviously with that. Growing up with dad going to properties, I got the little hands-on knowledge, so to speak. And then after that, I decided to move out to Chicago, and I fell in love with the city there. Great city. If you're 25 to 30, move out to Chicago. It was the best time of my life. But those are other stories. So as far as that, when I got out there, I ended up, didn't have a job, but within 2 weeks, I ended up working for Merchandise Mart, which is the big behemoth of a building right in the river of Chicago. It actually has its own zip code. It's the largest building in the country besides the Pentagon, or at least was 7 or 8 years ago. And the Kennedys owned it. And then a company called Vornado Realty Trust ended up buying a 51% share, and the Kennedys still own it. There's 800 tenants in the building. So I was doing the tenant repping, seeing how much TIs, tenant improvements, that tenants could go into spaces. So I did that for a couple of years, but then it was more forecasting and budgeting, commercial allowances and things like that. But it was a job at the time. And then I hooked up with these high net worth guys that started a mezzanine finance fund, which mezzanine financing is high risk leverage in the marketplace.
Like intermittent financing, right?
Correct.
Like a bridge financing for deals.
It's exactly what it is.
Before permanent financing.
It's exactly. So it's the equity gap bridge, which you just mentioned. Yeah. And so a developer will come and they'll pay low 20% interest rates. And it sounded, at the time, at first, I was like, that's crazy. Why would anybody pay 22% interest to fund a deal on a development or equity? But looking into it, it actually made sense because they would get a first mortgage, call it for 50 to 60%. Say they needed to come up with 75% down to buy something.
It allows it. Yeah, it allows it to do
they would
the deal.
have maybe only 40 or 50%. They still needed 25%. That would eat away from their returns on their profit at the end of the day. But they would then they would able to complete the project, still make a good profit. And so they lent on that, and they lent around the country. So I was doing more of the asset management, following up on the deals, how they were being tracked, because they were selling out. They weren't hold deals, they were for sale deals. So they were either single family home developments, condo developments, all around the country. And I was more on the asset management side. So I did the Chicago thing for a bunch of years, had fun, and then decided to move home. And then I came back, worked in the business, and then started my own company and been buying deals and doing deals ever since.
And when you learned about that, the mezzanine financing with the high net worth guys, that probably taught you how to structure more complicated deals, right? Because I think a lot of us are in the market and we do deals, but it's simple crap. It's like, all right, you put up half the money, I'll put up half the money, we split the deal, and that's it. But like, if you look at these big companies and stuff, the way they're doing these large deals, they're like fully capitalizing it. They're not using a lot of their own money. And like, it's hard for an outsider to even kind of understand how that was. Mm-hmm. So that was probably huge, because I know you guys have done a lot of big deals, like a lot of high dollar deals.
And there's 1,000 ways to skin a cat, and there's a lot of ways to do deals. I mean, the most conventional way, which most people do, is you come up with 20, 30% down, you go to a bank, you get a loan, and you do a deal. Yep. These days, you can structure a deal 100 different ways. A lot of times, in the last several years, I've really noticed using other people's money, getting a loan from somebody else, getting seller financing, whether it's getting 10 investors to each throw in $100,000 when you need to come up with $1 million and you each own a percentage. So that's happening more and more as as incomes have grown, people want a place to put their money. People are investing in real estate, and you can do that without having to be the dominating person in charge if you have someone managing the asset for you or taking the lead, and you're kind of in as a minority investor. So there's some of that going on. A lot of that's going on. And then for the bigger deals, which aren't localized, but more institutional in the city surroundings and high quality properties in the suburbs, you're seeing companies buying deals with private equity, pension fund money, institutional capital. And those are trading. That's what's driving those values higher, because a private equity or institutional company where you have a Harvard endowment fund that's invested wants a 2% return. So when you see how are these deals trading at these numbers, when you look at big office buildings or 200 to 300 unit complexes, it's because they don't need the rate of return that a guy like us would, that we're trying to survive and put bread on the table and things like that. So it's a different animal. And it just depends.
For you, is it more now you're limited on buying power, or you just can't find the deals? Because like, I feel like there's two ways to, like, you can be limited on capital, but I think the harder thing now is like, it's very easy to get money, but just the deals aren't there.
Yeah.
You know?
Yeah. So I would say, based upon and just studying history and not necessarily living it 20 or 30 years ago, but 20, 30 years ago, finding capital was the hard part.
Right.
Today, it's the complete opposite. Finding good deals is a harder part. Brokers have gotten wiser and smarter. Brokers have done this thing called, for investment properties, not for single family homes, but for investment properties, called call for offers, which is a buyer I hate. Because what that means is they bring everybody and their mother out and publicly market the property. And what happens when you get a lot of people interested in a property? It drives the price up. So the more people that know about it, the higher the pricing is going to go. You also have technology. Technology with information. When there's less information, it's advantageous if you can take advantage of that. When there's more information out there and everybody knows about it, the likelihood of you getting a good deal is less. Now, there's things you can do to structure to get the deal and win the deal. But if you overpay for a deal from day one, you're going to be unsuccessful. So that's the most critical thing in real estate, is don't overpay.
I also think every big deal that's like desirable, like Bell Station, for example, sold 3 years ago. All those big, cool deals to take you to the next level, they're all exposed now to every big buyer in the marketplace. So you're, like you said, you're competing against pension funds, you're competing against all kinds of crap. And it's like, you have to pay so much now, when I think 20 years ago, you probably had opportunities to buy those just privately from a seller.
Sure. And it's not just that, it's also on the term side. So you could have the capital. You could, if you were looking at a deal and say you needed $5-10 million of equity, if you had the capital, that's one thing. But if you go up and you're a bidder against 3 or 5 groups, and one of those groups is a firm that is represented by private equity, and they've already done business with a broker, and they know they can write a check today or tomorrow on the spot.
Yeah.
Even if you have the ability to come up with that money, they're gonna win the deal just based on their reputation.
Yeah.
Yeah.
And so there's also that factor.
Yeah.
And what you don't see in commercial investment properties is the back envelope things of how deals are put together, which can be complicated, convoluted, sometimes make sense and sometimes they don't. And why you win a deal and why you don't always know, or you may not always find out the truth.
Right.
And so but to go back to your question, yes, finding the deals today are harder. But with that said, there's always deals in every market. People thought we hit a peak 5-10 years ago. And if people invested, the people that have invested continuously every year for the last 10 years are super happy they did, because their investment has probably doubled or tripled.
Yeah.
People sitting on the sidelines, probably aren't as thrilled or as happy. So I think as long as you're active in every market, and my advice is to be active in every market, time will take care of itself. I have a philosophy that if you can do, every deal you do isn't going to be a great deal.
Yeah.
Okay. You want it to be, but you try to vet it out and do your due diligence, but it's not. But if you can limit your dogs, if you can do 9 good deals and your 10th deal, you limit as your bad dog and your 10%, maybe you limit your exposure there. So you want to be diversified enough. You want to have some risk there, allocation, but you also want to have safety cushions or blankets. Always have a plan A, B, and C for each property.
Yeah.
And back to your point on leverage, and how many, I believe in leverage. I like debt. Some people don't. Some people want to pay all cash and have no debt.
Yeah.
But there's good debt and bad debt. And so if I said to you, is credit card debt good debt or bad debt?
Bad debt.
It's bad debt. But what's real estate debt?
Unless you need to use your credit cards
Right.
for a down payment to buy something.
Exactly.
So you can transfer the bad debt to good debt.
And the reason it's bad debt really comes down to interest rates. The interest rate is 3, 4, 5 times the amount you could get from a regular commercial loan.
But here's the question, not to interrupt you, but like, do you think when like Barbara Goldberg was first buying properties, or your family was first buying properties like in Beverly, don't you think it's just different, but they were still leveraging up?
Yeah,
Like-
and she was brokering property. She really didn't buy any. She only had, I think, a handful at her death. But she was a broker for
Right.
single family homes. Now, my dad and his brothers, yes, they were buying, but they were also the only ones doing it at the time. Real estate wasn't sexy back then. My dad at the time was the only one buying multifamilies in the area and fixing them up. And he said, "What am I, a masochist?" Because
Everyone thought it was dumb, right?
Right, the
Everyone was
mayor-
in the stock market, and that was the big.
Yeah, Mayor at the time before Scanlon wasn't as pro development as they are today. So your administration, because you need the political community behind you, you need the financing community. Well, you couldn't go into the bank and get lines of credit back then.
Yeah.
You couldn't go into the bank and readily get mortgages on things and come up with them. So, and 10,000 back then is like 250,000 today for a down
Right.
payment. It was what it felt like. So, and values were to buy multifamily property would have cost you probably $20,000 to $50,000 in the 1980s. So
were they fully financing any of them back then?
not
was it like
fully?
because
No,
there wasn't bank
no. You
regulations
still had
as
to put
much.
down. You still had to put down your down payment. The down payment
Was it 20% or less?
I didn't. I wasn't around,
Yeah.
so I don't know. But I think
I always wonder about that because I feel like a long time ago you almost used to be able to like walk into a bank, and if you know that like the president of the bank, it's kind of like
once you got the
loan's done.
reputation, it was
Yeah.
easy. You do it on a
That's the
napkin,
thing. I mean,
Right,
you hear
you're
about
done.
guys going to auctions back then that the bank would just finance 100% of it.
right?
Now, like I don't know if you
There's
commercial
bank
loans,
regulations.
my
now,
commercial
certain banks
loans,
want-
I hate doing them. They're
Mhm.
just such a pain. It's
Mhm.
like you got appraisals, personal financial statements updated every single time. They want it's like you almost need an employee to do all the paperwork for commercial loans.
Oh,
now.
you do, and you have to.
Crazy.
A lot of people don't know this, but you can negotiate the language in your commercial loan documents to a certain extent. A lot of it is boilerplate, but if there's certain things to protect you more so from a rainy day when stuff hits the fan,
Right.
then you want to put some kind of covenant protection in you if you are in default to kind of get out of situations if you can.
Do you use local banks or
I like using local banks because I like knowing if there is a problem there. You can go talk to the bank president or
That's
the
what I
senior
think
loan
too.
officer. So I don't like using institutional Fannie Freddie Mae unless it's a larger deal.
Yeah.
Then it makes a lot of sense for a lot of reasons. But I think for the local banks during the whole countrywide crisis with the mortgage crisis that we had, the local banks were not impacted because the local banks know who they're lending to. They know their real estate. They know the people. And so the local banks are not the issue. And unfortunately, that's why you see a lot of these local banks merging because they have so much, what do they call it? Not guidance, but that they have to, regulation that they have to go through from auditors and compliance. They
don't
have so much compliance requirements that they have to do that it becomes a hindrance on their profitability because now they have to hire just a compliance loan officer just to deal with being compliant with rules that really impact bigger financial banks.
Right.
So the local banks in the area are great. I hate seeing these mergers, to be honest. I wish they didn't merge. Because then there's less and less local banks, and then the smaller banks start becoming regional banks. So I like that small time feel.
Yeah, me too. Well, Beverly Bank, I don't know if you noticed, changed a lot when it's merged.
Oh yeah.
I mean, everything's different in that bank now.
Oh yeah.
All the rules, all the regulations. I mean,
yep.
So
and every bank is different. You go to one bank and a check can be made out a certain way, and some banks will accept that money, and other banks won't. But they've been doing so. There's certain banks have an appetite for certain things, and they can also change on a dime of what their interest is today. So if banks are giving attractive terms based on what you're seeking, go after that bank and use them while they're hot because they can turn and have a loan committee meeting and say, well, we're going to go in a different direction. We're not going to do that anymore. So
interesting.
So I know you talked about it. You said that you want to buy in every market consistently, but I mean, obviously you've been one of the most active buyers over the last few years. A lot of investors that we talk to basically say like, right now, times aren't good. They're going to wait it out. So like, what are the things that what you're looking for in those deals that really have had you buy consistently where other people might right now just be like holding cash, hoping for a downturn in order to pick up some property?
Because you've done a lot. I mean, in the market, the bigger deals like the 2 million plus, a lot of them have had your name on
the thing
as
is,
a partner, as a primary buyer.
The thing is right now, I haven't, because I'm working on a big development project that's consuming a lot of my time and resources. And so until I'm done with that project in Salem, it was the old former Knights of Columbus property that I'm converting into 18 luxury residential apartments. I'm trying to make them the nicest apartments on the North Shore. High end, I'm making them condo quality. The amount of money it's taking though is just obscene because it just, every time you do a project, it always costs more and it always takes longer. So because of that, I'll probably be a little less active until it's complete this fall. Yeah. And so, or end of summer.
You expect end of summer, fall.
End of summer. Yeah. September 1st is our push date that we're aiming for, but it could leak into the fall, but we're shooting for that date because that you don't want to miss the rental market.
It's how many apartments?
18. Yeah. And so, they're really good square footages as well. So that's
going to set the sale market.
It will be a new bar
because I mean, where that is, like I live right near the it's like, I mean,
it's on the quiet side of the common, opposite end of the Hawthorne Hotel. We're going to have stainless steel appliances, quartz countertops. We have parking on the property. It's going to have automated lock entry doors.
I feel like that's the hottest area of Salem too now. The common area, and like almost now going towards Derby Street versus like the Federal Street and like Essex Street, Chestnut Street have kind of cooled a little. Like people want to be common in that way.
And how I coined the property, it's called the breakaway. And the reason being it's a break away from everything, but still a quick, you cross the park and now you feel like you're in an urban environment, or you walk a few more minutes and you're at the train station, take you into Boston.
Well, the friggin' best is you can go straight to Beverly.
Exactly.
Like,
you can miss the traffic.
That's my house.
Back end and go to traffic.
It's like, so nice.
Yeah. So I love it. I'm excited about it and looking forward to it. But I also look at real estate from a long-term perspective. Each property, you should probably have your own goals for each property. Yep. And, do you want to hold this long-term? Do you want to hold it short-term?
Do you have a specific plan going in?
Yes.
With each buy?
Yes.
How long are you going to hold it for? When are you going to exit for?
Conventionally, if I'm keeping it, when I say in the portfolio, where it's just my assets or immediate family asset that I'm managing, I want to hold it long term usually.
Right.
Yeah.
If I'm bringing in outside investors, it's usually a shorter hold because people want to get their money back in their return and then redeploy and do something else. So,
Right.
and so because to get your profit is really on the sale.
Yeah.
So you can't make your return until you sell if you've hit all your targets and performed on the property. So you can't do that unless you sell. I guess if you refinance, you can. And that's an option too, is to refinance and get a supplemental loan.
Do you use cash flow goals more or like asset value goals for long term? Well, it's kind of a mix, you know?
It's a combination.
It's hard to say which one's more important. Like cash flow is awesome, but you also want like the more assets you have, the more your leverage is, the more as the market appreciates, you have a lot of opportunities to exchange, opportunities.
Yeah, it's really a combination. And then also another part of that too is also debt pay down,
right?
Principal payment.
Yeah,
so
exactly.
My favorite checks to sign, and probably my only checks to sign, is the mortgage statements because I like looking at the principal reduction every month. Yeah. And so, so when you get principal reduction and you get appreciation, if you get appreciation is not guaranteed. Okay, there will be a point. I remember even listening to a educational class I took where 10 years ago, a very respectful person in the real estate industry, still in Boston, who's still in the market today, was really hammering deflation. Well, that never happened, and so there could be a period where you do get that, and then rents may not always go up; they could go down and pull back. So my goal is if you can make a property work from day one, or at least you're going to perform it to a point within a year or two to get it to where you want it to be. Even if the market goes down and you can lock in your debt long term, you should be somewhat solidified from your downturn risk.
Right.
Somewhat, not completely, but somewhat.
Have you done blanket mortgages on stuff? Like,
yes,
almost like simplify it, have 5 properties, one big loan on it.
Yeah. So just to, for if someone doesn't know, a blanket mortgage is where you secure a loan through multiple properties.
Right.
So we have done that. And also over time, you can get properties released. So if values have gone up or cash flow has gone up, you can go back to that bank and say, all right, I've secured this loan through 3 or 4 properties. Well, I want to release 2 now.
Yep.
And
That's
so you might have to get a new appraisal for all the properties or 1 or 2. Again, that comes back to your loan docs and how you structure it during that blanket mortgage.
Right.
And so that always is an option. And then there's always lines of credit where you can get an equity line, which banks don't like to do. But sometimes if you have a good relationship with the bank and you've done a few loans with them, to go to them and say, I would like to put, when people think of an equity line, it's a home equity line on their home. But on a home equity line on your home, you pay principal and interest. If you get a commercial line of credit, you only pay interest.
Right.
So you save on the principal payment. Now you can still pay down the principal, but it gives yourself flexibility. So if you own a commercial property, you have an option. Do you want to go, you could get a first mortgage and pay principal and interest on it, or you could get a commercial line of credit. Now, in a commercial line of credit, a bank may not give you as much of a loan. They may pull back 5 or 10% from what they would give you on a first mortgage,
right?
But you could still get it. And it gives you flexibility to either use it for operating cash flow, for expenses, or for a down payment. And so, especially if you do a value add where you're going to go into a deal for, a year or two, create the value, refi or sell, then you get your money back, you pay down your loan. It's almost like if you can make the numbers work, it's almost you're into the deal for very little or for free at the end of a year or two with your sweat equity.
Interesting. How many employees do you guys have?
At Spire, we only have 2 in the office, and then we have a crew of 5 or 6 that are out about properties.
Interesting.
So.
Absolutely. I mean, I guess for like first time investors coming out and they're trying to buy 2, 3, 4 families and trade up, like what would you say is the best way to go and do that and then leverage those buildings? Because they're not going to have commercial lines of credit coming out with those buildings.
I think the best way is if you can go after a 3 family and live in one of the units, because then you can get the home, the residential rate as a home buyer. So you live in one of the units, you rent out the other 2 that can hopefully pay for your mortgage, and that gets you started. That builds you some wealth, builds you up get a little bit of cash flow, get principal reduction over time, create some value there. And so I think that's a good way to start, get your foot in the door. Beg, plead, borrow whoever you need to come up with a down payment.
Right, just
friends.
figure it out.
And take it from there. So I would say if you can get a 3 family and live in it, get a residential home mortgage, that could be your way to start.
And then also on that fact, so say I'm trying to buy I own that 2, 3, 4 family and I'm trying to leverage up quickly. Peter was talking about, are you more interested in like location, the equity, or like the cash flow purposes of that building? If you're first starting out, is cash flow more important or having that perfect building in the perfect spot?
Sure.
Long term.
Again, it comes down to what is your next step.
Yep.
So, and I can't, everybody, each individual listening
There's
or
different
needs to answer that. So for, you know, if you're going to buy something and you're going to say, I'm hoping to increase the value because this property, I can increase another 50 or 100,000 just by doing this, this, and this, and then I'll sell it to move on to something else. Then the cash flow is not as important, but let's not be wrong. Cash flow dictates value. So the higher you can get your rents, the higher value you can achieve on a property. So it's almost codependent.
Yep.
And then it depends on goals. And that's why I think you have a portfolio. Once you get established, it takes a while. And this isn't your question, but if you get long-term plays and short-term plays or middle play, like in between, you have a little bit of everything going on.
Right.
And so I think it's a combination.
Right. Absolutely.
What's the biggest deal you've ever done, dollar-wise?
Just closed last year with my partner with another company I'm involved with called Arrowpoint Properties. We bought a $29 million deal.
Wow.
We brought on investors.
Okay.
Wow.
So
That was a apartment complex? Or
yeah, in Methuen.
Wow. How many units was that?
140.
Wow. So what's that a unit? Like,
that came out to 209 a unit, I think it was.
and when you closed on that, was it a buy based on upside or just strictly?
That was a value add, complete value add. So the owner of that property owned that property. It was a family asset. They've owned it since they were the ones that bought it and developed it in the late 80s. And so they were the only owner. And the father had died and the kids wanted to sell out and get their big chunk. So
do you kind of renovate the units, raise the rents?
go through, renovate units one by one. But a lot of real estate, people make it think it really comes down to management and operations and who's in charge. So you could buy a great deal, but if you go into bed with the wrong partner or you have a bad manager, not a good operator, then it doesn't matter what you buy the property at. Conversely,
that's interesting.
If you overpay for a property and you you overpaid, then if you have good management and operations in place, you can actually make it work.
Yeah.
But if you're doomed, if what I first said, if you don't have good management in place or good operations. So, and you get that through experience, you get that through relationships, you get that. So it's just why are some managers better than others? Why are some brokers better than others? Why are some people more successful than others? Why are some people doing more deals than others? It just depends on your drive. It depends on your abilities and to perform and how much you want to do and how much headaches you want. Yeah. So there's a lot of those factors.
Who's dealing right now with like the day-to-day for you, like the tracking water bills, making sure one's not too high? Because there's many little details.
And I still have my pulse on on everything. I really do on everything. I mean, there's not enough hours in a day, but I have my property accountant and then I have an assistant that helps with, paperwork and things like that. But there's so much to stay on top of.
And there's so much money that can just fly away.
Oh yeah. And so you have to stay on top. And it's as simple as, okay, yeah, they're producing the water bill. And for instance, I just signed a water bill. $6,000 for an apartment building. But I realized that no one else, they're just printing the check.
That's what I mean. That happened to me too.
So we had to do a walkthrough of all the units and we found out there was a leaky toilet that was been going on for months in one of the units and the guy didn't report it. Yeah. So now I'm going back trying to,
and you just get pissed at yourself. Like,
but that's needless money. That you shouldn't have to spend.
Yeah.
And so there's things like that just come up constantly.
Yeah.
And you guys are probably like me. You don't ever shut it. Once you get the real estate bug, you don't shut it off.
No, never.
And you can be at night and you're doing texting and it just doesn't stop. Or you get maintenance calls or, God forbid a fire or something, So
you still keep your pulse
on everything.
Okay. That's interesting. And how
I'm probably rare like that because I'm involved with, I go through every apartment when it comes up. I don't leave it to somebody else. I go through decisions, I sign every check.
How many tenants do you currently have? It's hard to say. I know there's different,
and then there's different ownerships and different companies, and I'm involved with because then you have my company, then you have the Arrowpoint, and then you have the Goldberg property. So I'm involved
really
in
hard
3
to
companies,
say.
so it's hard to say.
But there's a lot of stuff going in.
There's a lot of stuff, and it's both commercial and residential tenants.
Yeah.
So,
and then the leases for commercial, that must be hard to track all the time because of triple net charges.
Yeah. So that's always challenging. Now I have a software I use which helps with some of that. But I I write the majority of my own leases.
Yep.
So there's maybe, I would say 5% of my leases I don't write if it's a bigger corporate type tenant, or that it's going to be more commercially geared oriented. But I write most of mine, and it's been fine.
Yeah.
So
Do you find commercial lease negotiation is takes a while and is hard? Can be.
It can be, but it really comes down to, usually if I'm negotiating with a tenant, once I've given them a letter of intent to a proposal to lease the space, I've kind of feeled them out. They felt me out. They've kind of passed my eye test.
Yep.
Right.
If I want them as a tenant, it usually works out okay, because you're not going to want to deal with someone who's combative.
Right.
Yeah.
And so,
Absolutely.
and they have to accept your terms. You're kind of in the driver's seat. And if it's not happy, sorry, this unit, this building's not for you. You're not going to be you're going to be renting from me. So I don't think so.
Yeah.
I think it just comes down to what the deal structure is, and you have two business people just trying to make a deal happen.
Yeah. What percentage you to commercial to residential? I know you talked about that. Obviously, you guys own commercial and residential.
Yeah.
What's kind of that proportion?
So at Spire, I'd say we're probably 80% residential, 20% commercial.
Yep.
At Goldberg Properties, I think they're more opposite. I think
Yeah.
they're 80 commercial, 20% residential. So.
And is that because you're
And I'm
more
guessing
comfortable
on that.
with the residential side, or that's where you've seen opportunities?
It's both, to be honest. I don't pigeonhole myself. The commercial could be retail, office, industrial, land, even land, residential land, or multifamily or single family home flips or whatever.
Yep.
So I like it all. I don't, like I said, you got to find opportunities.
Yep.
And so, for the listener, you're looking at single family homes to invest in, a multifamily 1 to 4 units, a single family home to flip. That could be a good advantage. And for people out there, if you're trying to make money, one way to do it is, if you have friends or family that want to sell their home, don't let them list it with a broker. No offense.
Right.
But go out, get the deal off market, deal directly. They save on the commission, which you'll be able to then attract a lower purchase price going in, because they don't have to bake in that commission. And then you now have a little equity to roll into that property. And then when you've increased the value, then go out and give it to a broker, and then they'll sell it for you.
So what's one of your, just briefly, I know it'd be hard to explain them all, like what's a huge winner of a deal you had, and what's a huge loser? You have any ones that stand out, like a home run or a complete fail? Because I've had both, and I'm sure you've had both.
Yeah, I would say, fortunately, to be honest, nothing like with a complete fail, like some deals that you maybe. Well, on a complete fail basis, I own a property. I bought a 6-unit in Dennisport, and I turned it into 8. But I didn't have any relationships down in the Cape.
Yeah.
I bought it because I picked the property up for $300,000 for 6 units, which I thought was a steal at the time. And it was a 2-hour drive just to get down there to the South Shore. I ended up, there was problems with, renovating the units. It was on a septic tank. You had city people saying I had to do this all and fix things constantly, and it was just a hassle. And so I hired a guy to go in to help with the build out of two of the units to make it 8 units. I trusted the guy. He seemed good. He was basically stealing money on the fee. And so I didn't figure that out until I'd already paid him like $50,000. Wow. And so that was probably my biggest failure. Yeah. However, I ended up hooking up with a guy who was kind of a knight in shining armor in the area, who kind of was like the mayor, who just kind of had a construction crew. That he liked me, I liked him. We got friendly, and he helped me push that, got that through, made it 8 units. And I ended up selling that property a year or two later, within 3 years, for $1 million. So I made it back.
But it was rough getting there.
But it was rough getting there. And it was for a 6 or 8 unit in the Cape. And now if it was 100 units in the Cape, then maybe it would have been worth it, or you would have had enough, because you need the scale to get management in place. But it was a good learning curve from that standpoint. So that was probably my biggest fail. My biggest score was before the Methuen deal, was a property in Haverhill we bought in 3 years. We bought the property and did an exchange, and that was a home run deal because that was 164 units. Yep. Sold it and did the exchange into Methuen, and brought in some money on that. So
how long did you own the Haverhill deal for?
3 years.
And was it a value add type of thing? Yeah. You guys raised the rents.
Yep.
Got it.
Yep.
That's pretty cool.
So yeah, me and Peter talk about this a lot. Like, so right now, real estate's obviously hot. It's popping. Everybody wants to buy it. So everything in that, like, 500 to 2 million range, you have a lot of guys. And then obviously Peter talks about how the bigger deals, really, that's where the opportunity is. Is that what you see? Is that why you guys have gotten involved in bigger things?
Yeah, actually, I think there's more opportunity in the smaller deals.
Yeah.
Because I think that on the smaller deals, you have a lot of unsophisticated owners or operators, as I mentioned. And so I think when I say that, but the problem is when I say when you define
what are you considering a smaller deal?
Right.
Though?
Well,
what's your dollar
when I
size
say
of
smaller
that?
deal, when you $300,000 to $500,000, $700,000, $1 million. Okay. Now, when I say opportunity, you could maybe buy a property and create $50,000 or $100,000 pretty much overnight of value pretty quickly if you buy the right deal.
Yeah, I agree.
The problem is the amount of time you're going to spend on that deal is going to take you the same amount of time buying a larger deal
Right.
to create the same value. So you have to prioritize. So when I say it just depends on what you consider opportunity from a risk, a dollar percentage or return percentage, because it's two different things. You could make 20% on a $500,000 deal, and you make $100,000. Or if you make 20% on a $5 million deal, now you've made $1 million.
It's a lot different. Yeah. And that's where leverage comes into play, kind of.
Correct.
Because it's like, if you have the ability to borrow that mezzanine financing type of thing, your scale is so big, it's worth paying the 20% if the deal works.
Correct. However, on the mezzanine side, to get back, you pretty much have to sell.
Right.
To get out, you need to be in the mindset that I'm going to sell this asset once I create this value to get your money out. But there's a lot of other factors in real estate. There's taxes, there's commissions. So at the end of the day, what do you really keep as profit?
Right.
And is it worth all the work, heartache, and hard work to get there? Because people throw out numbers, and I've thrown out a lot of numbers tonight, and it can sound good and glamorous, but it's not as much sometimes as you think when you realize, well, I have to come up with this money. How much money do you have in the deal? How much is investor money for the amount of headaches? And then there's other reasons to the deal. It could be the management fee income you get from managing the property. So it just depends. Again, personally, what is your goal? What are you trying to achieve, and how are you trying to get there?
What do you dislike the most? Like, what's the hardest part of the business for you?
I think like anything, headaches, but that comes with any business. dealing with maintenance headaches and irate tenants when they have a problem, which you try to deliver on service to help, so they realize that you're a good landlord, that you keep them long term, especially on the commercial tenants. Because if you're good to them and you respond, the likelihood of them renewing their lease is strong. If you ignore problems or become combative or argumentative, then even if you're in the right, then you could lose that tenant. So I think just dealing, but I also enjoy talking to tenants, enjoy meeting them at the properties, enjoy getting to know them. So I love that aspect. I think it's just maybe more the maintenance that comes with the ongoing.
And some of it is just like impossible, right? Figure it out.
You're never going to win all the time.
Because we're in old towns with the plumbing's old and the buildings are old. And it's like some things you just can't even figure out what they are.
Some things we just had to replace a water sewer line that you get no extra value, and it costs $25,000 and you get no value by fixing that.
Wow. Did you have to go into the street to do it?
We had to dig it up on our property, open up the sidewalks. You have to pay a sidewalk permit to the city, open it up, fix it. The one thing we did do while it was opened up, we said replace the gas line that's there as well, because it was open. So we didn't have to do it, but it was older, so just replaced it, so we don't have this issue again in the future. So
now it's just a shock.
Correct. And that was just fixing the pipe. Then you had to pay a mason to put it back all together, and then landscaping, et cetera, et cetera. So there's things that come up that don't add value when you own property. When you go to buy an asset or a property, you do want to look at a lot of factors. You want to look at the building itself, the age, the mechanicals, the roof, the structure, foundation. Certain buildings, if they have bad bones, you don't want to buy that property unless you're planning to tear it down. So,
do you do inspections on properties you purchase,
sometimes,
or not always?
Sometimes, but it always wows me though in this market because it's so competitive. There's good owners and bad owners, and people have reputation. So who does good work. And if you buy from a good owner at a reasonable value, then that you're going it, then you feel pretty confident. If you're buying from an owner that you can tell hasn't really fixed much or spent much on the property, letting things decay, and he kind of just bled it, then it's amazing the prices they're getting. And people are offering prices without seeing all the units. They're just looking at, price per unit. And it's like, they're just, because they know something else sold for this. So they're just throwing out numbers, and we all do it.
Right.
But
Absolutely.
it's kind of mind boggling if you really think about it. Well, you might have only walked into 10% of the units or something, and you're throwing out, millions, $100,000s of dollars of an offer.
I think sometimes the problem with that is
you have to do it to get the
exactly.
Sometimes,
someone else is going to do it. So a building might sell without anyone going in some of the units, right? I feel like. So if you don't do that, you could miss out on a good deal, even though someone else is going to do it. So it's like,
so
I don't know.
It's one of those risks we take.
Yeah.
But to go back to your original question, Nick, but I think if you buy in every market, it will over time take care of itself. If you can just make a deal. If you can make a deal work on day one, no matter what the market is doing, I like to think that you will be okay long term.
Yeah. So I guess the other thing is like while we're looking at those deals, and obviously you buy in any market, is there a certain space, whether it's retail, commercial, residential, that you might not take that chance in every market?
I think you have to be a little more careful with commercial, because if you own a commercial building and let's say it's a single tenant asset or a 3-unit asset, call it a single tenant. Right? If that one tenant leaves, you're great when it's 100% lease. But if it's 100% vacant, you're hurting, because not only do you have to pay the mortgage, but all the triple net CAM tax charges that you have to pay along with the property, your taxes, your insurance, water, that doesn't go away. Right. That the tenant was paying for you. Now you have to pick that up, and that's going to hurt. So you got to, again, it's a diversification play. What's good? Commercial has less headaches. So there's a benefit there. And you get a check for the next 5 or 10 years, whatever the lease term is. But after that, if they don't renew, and then when you go to resell, if there's less term left on their lease, what's your value? Because now you might have a less, value is not just the rent, but it's the length of a lease in commercial real estate.
Absolutely.
I guess it's a little situational dependent, but say you have a long commercial lease with a business and the economy changes, the business, whatever, goes out. Do you pursue them always? Like I know people like Cummings Properties have a reputation for pursuing their business tenants. Have you been in that situation?
No.
And how do you deal with it?
No, I actually like that Cummings does that, because then they usually come to us first. Right. Because then you're more reasonable. So I never do that. Yeah. And because
it's like, what are you going to get? I mean,
exactly. You can't get blood from you can't get blood from the stone. So then it comes back to the basic principles of, okay, if you're buying commercial property, location, where are you buying it? Right. Is it a good location or not? Is it at a hard corner, quarter intersection or not? Or is it off the side road in the back somewhere? So, and then the building itself, does the building lend to flexibility? Right. How much flexibility? Have a plan A, plan B, plan C when you go in to buy that property. Sorry, they're under lease for 5 more years. I'm happy I'm buying it. If they stay in 5 years, great. It's a huge win. Structure your debt in a fashion that you're comfortable. And if they leave, this is my plan B. If they don't, and if that doesn't happen, I have a plan C. Now, sometimes there might not be a plan C, but always have a plan B. Try to have a plan B and C.
So I guess obviously along those lines, so a lot of the stuff that you own is Beverly, Salem, obviously did the big deal in Methuen. Is there certain places that you see more opportunity than others right now in certain areas around?
And then the other thing you can do, which I've done some, is invest with other groups as a limited LP, as a limited partner. So you can invest where you have no control, and you just invest so you get your money working for you, and then these deals could be anywhere. So I've done some of that as well. And I like that because you don't have the management headache. You get a check every quarter or whatever, often however they pay. And that's nice to diversify. And then you want to see what's going on in the market too. So that's always good. But your original question was what on that?
Which is there's any other areas around here that obviously you bought that deal in Methuen, or the areas that maybe other people aren't looking, that you find would be a good place to look? Or is it just, do you take a deal on deal?
No, I think it's just deal specific. So you walk into a building and you may see something that someone else doesn't see. Yeah. And you may, like when I bought the Knights of Columbus, not one, there were probably
there's a lot of people trying to buy that.
Yeah, there was about a dozen groups that I think tried to put offers on that. Yeah. And not one group envisioned 18 units like I did in the fashion that I was going to design it in. So
were they less? They were all
they were all
whatever they could fit in the building, right?
Correct.
Because you figured out a way to build an addition.
Yeah, a lot of them were building town row homes in the back, or smaller units or whatever. And so you just walk in and sometimes you either see it or have a vision or not. And I may see it on one property and you may see another property. I may miss it and you may miss it. It just depends. You may want to buy it because it's close to your office, and it might be an extra 5-10 miles for me to get to. So maybe I'm not as interested in that property. Right. How often am I going to have to be there? Right. And so there's not 1,000, but there's a multitude of things in your own head that's important to you that you have to determine, is this what I want?
Right.
Thank you guys for checking out our Long Game podcast today. We're going to be coming at you a lot more often over the next year. If Feel free to check us out at HERRICKLUTTS.com.
Subscribe, follow, hit us up with questions, and we're out.